Beta and systematic risk are foundational financial concepts that play a critical role in legal practice, especially in business valuation, damages calculations, and securities litigation. Legal professionals must understand how these concepts are defined, calculated, applied in court, and scrutinized in expert testimony to effectively advocate for their clients. Understanding systematic risk in legal contexts. Systematic risk, also known as market risk, refers to the portion of total investment risk that impacts the entire market or economy. It arises from factors beyond the control of any single company or individual, such as economic downturns, interest rate changes, geopolitical events, or natural disasters. This type of risk is non-diversifiable, meaning it cannot be mitigated by diversifying a portfolio. For legal professionals, systematic risk is critical in cases involving business valuation, securities litigation, and damages calculations. Courts often scrutinize whether systematic risks have been properly accounted for in expert testimony, as these risks affect the valuation of assets and the calculation of damages. What is beta? Beta symbol. Beta is a numerical measure of a security's sensitivity to systematic risk relative to the overall market. It quantifies how much a security or portfolio is expected to move in response to changes in the broader market. Beta symbol, measures a security's sensitivity to market movements, indicating its level of systematic risk. A beta of 1 means the security moves in line with the market, while a beta greater than 1 suggests higher volatility than a market, e.g., tech stocks. Conversely, a beta less than 1 indicates lower volatility, e.g., utilities. Rarely, a negative beta implies the security moves inversely to the market, such as certain hedging instruments. Why beta and systematic risk matter in legal practice? Beta, a measure of systematic risk, is crucial in legal practice for business valuations, damages calculations, securities litigation, and expert testimony. It is a key component of the capital asset pricing model, CAPM, used to calculate the cost of equity in valuations, with courts scrutinizing whether beta reflects industry and market conditions. In securities litigation, beta helps determine if damages stem from market-wide risks or other factors. Misrepresentation of beta can lead to disputes over liability. Courts also expect experts to justify beta calculations with empirical evidence, aligning with industry standards to ensure credibility. How courts treat beta and systematic risk. Beta is critical in legal cases for valuations, damages, and securities litigation. Courts demand rigor and transparency in beta estimation, preferring weekly/monthly returns over daily data to avoid volatility. They accept 2- or 5-year beta calculations if justified by literature or industry norms. Subjective company-specific risk premiums, CSRPs, are often rejected unless supported by objective evidence. CAPM, incorporating beta, is preferred for discounting cash flows. Expert testimony must meet Daubert standards, ensuring reliability, relevance, and clear methodology to align with legal and financial principles. Best practices for legal professionals. Working with experts. Vet expert credentials. Ensure adherence to accepted methodologies, and prepare thoroughly for depositions by challenging assumptions and focusing on methodology. Anticipate Daubert challenges by confirming the expert's approach is testable, peer-reviewed, and widely accepted. Red flags and reports. Watch for analytical gaps, unsupported assumptions, deviations from standard practice, or signs of bias. Communicating to courts. Use clear, jargon-free language, visual aids, and relate beta/systematic risk to legal issues. Prepare experts to explain complex concepts in simple terms. Key takeaways for legal professionals. Beta measures a company's exposure to market-wide, systematic risk and is critical in business valuation and damages calculations. Courts require beta and systematic risk to be calculated using transparent, objective, and standard methodologies. Legal professionals must effectively challenge or defend expert testimony and clearly explain these financial concepts to judges and juries.